Hi YouTube, welcome to the Stocks and Sharing channel. If you're new here, please drop the video a thumbs up and subscribe to the channel. It will help out in a massive way. So as it says, I've got 3 stocks here on my June radar. One of the stocks I do own, and the other 2 that I've got here, I'll give you an insight into why I like it and also any price points that I'll be looking to initiate a position in these. So let's get straight into it. First stock we've got here is Cardinal Health, ticker symbol CAH. This is a 16.26 billion company. Price to forward earnings coming in at 9.5, so it looks cheap in that comparison, and you'd be picking up a dividend around about 3.5% based on the current share price. So Cardinal Health, they're a healthcare service provider company based in the United States and international. So these guys, they issue out equipment that's required within pharmacies and hospitals, and they vary from the standard sort of equipment that you'll see to really specialist equipment. And it's got here the likes of nuclear, radio, pharmaceutical manufacturing facilities. So really good company, reliable. It's always going to be needed. And if we look at the financial side of things, for the annual revenue that's came in for July 2020, 152 billion. And it looks as if this is going to increase year on year, kind of mid digits over the next few years as well. Earning per share, this has been from 2016, 2017. It's actually been going down between that period, but it looks now as if they're turning a corner and it's on the ascendancy. So fingers crossed that can remain true and they continue to deliver on this turnaround play. Price to earnings, as I said, forward earnings coming in at 9.5 based on 2021 earnings, and year on year we're looking at a 5% increase, all going well. Dividends get 3.5%, low payout ratio of 33%, and they've also got 16 years of growth behind them. That will include the financial disaster and also the coronavirus pandemic, so you know that there's a good chance that this dividend is safe, and with a low payout ratio there's going to be room for it to grow. There's been a large downtrend for the last few years, and it's been bouncing off the top end and the bottom end of the chart shown here. Recently it looks as if there's been a solid bottom put in here, around about the $42 to $43 range, where it's almost came down to test it, but it's bounced off it and is now on an upward trend here. Since halfway through 2018, when the share price reduced, it's created this level here of resistance where it can't seem to get around the $60 mark, and the one time that it has been through it, again it's came back down here. For me personally, I'm looking at this, and if this can get down to somewhere around the $52 mark, round about here, I'd be happy to initiate a position in here, and we're getting paid the dividend to wait as well until the share price comes back to full health. Second company I've got here is Verizon Communications, large telecommunications company sitting with a market cap of 230 billion. You've got a price to forward earnings of 11, so it's fair value, and you've got a dividend yield of close to 4.5%, which is always enticing. Revenue growth for Verizon. Verizon is a steady Eddie company. They issue fixed lines and wireless. So for the last few years, very similar earnings around the 130 billion range. But looking forward, with 5G kicking off, there'll be a super cycle of wireless phones which will come into play, and they'll also have that for issuing out for the likes of the telecommunications masts. There'll also be an emphasis on fixed lines. I'm bullish on telecoms due to the fact that there will be companies operating a hybrid work from home, work from the office model, and one of the requirements for this will be to have a suitable fixed line. So certainly over the next few years, I'm quite bullish on Verizon. It's not going to make you rich overnight, but it's somewhere to preserve your money, and you'll get a steady 4.5% dividend based on the current rate. Earning per share coming in, as you can see there, it's going up nicely over the last few years, and for revenue growth, they've got here again, it's going to be kind of mid to low single digits year on year. Dividend payment, we've got about 4.5% yield, as we've said, and the payout ratio is bang on the 50% mark. Verizon, it's basically a utilities company, so to get a 50% payout ratio on that, it's got 8 years of growth behind it, and these have gradually been going up. There was a reduction in 2013, but since then we can see here that it's kind of evened out, and with 8 years under the belt, I'd be happy to initiate a position in this one. We'll take a little look at the chart. We've got a solid bottom in here, round about $53, $52. It's tested it 1, 2 times, and it's bounced off it another 2. There's also been another level here just above where it looks as if it's came down and tested it and bounced a few times. We've got 1 here, 2, and we've got 3 and 4. You can see the share chart's been kind of bouncing up and down within this range within the last 2 years. And if this currently comes back down to here, about the $54 mark, 54.5, I'd be looking to lock in a starting position there. And with a 4.5% yield, happy to sit on this one. And the last company we've got here is it's a UK based company called Beasley, and they are a company which specialise in insurance. It's non-life insurance, so it's risk insurance, and there is no price to earnings on this at the moment due to they swung to a loss of about 70 million last year. This was before the year previous where they had a profit of about 251 million. But the revenue, looking at the chart, the revenue is still going up. This company is one of the worst affected companies from COVID. So as we know, hopefully COVID is only going to be in the rearview mirror and things will be progressing back to normal. So this is a recovery play that I've got. It's at the share price right now is about the same sort of price, or actually cheaper from the initial COVID-19 drop. So you're getting this at a reasonable value, and if I just show you the technical analysis on this, you can see why I think it's a good position to open up just now. From 2017 and even beforehand, they've been on a long upward trend, bouncing off of this trend line here, and when it's cut through it, the share price has started to consolidate. It also tried to retest it, but it bounced off it. Since 2018, it's been fairly range bound, bouncing up and down and consolidating. Before in 2020, it's crashed through that support level. Looking at it just now, it looks as if we've got a bottom in here about the 300 or just below the 300 mark. It has come down fairly recently to just about test this, and it's came up. We've also got this downward trend line, which acts as another point here. As of yesterday, it's closed above it, so it'd be interesting to see here if this comes back down below the trend line, or if it can start to break out. So guys, that's the 3 stocks I've got here. If you enjoyed the video, please give it a thumbs up, and I'll be sure to see you in the next one.